I'm Charlotte McLeod with the Investing News Network, and here today with me is Eric Nuttall, partner and senior portfolio manager at Ninepoint Partners. Thank you so much for being here. Great to see you.
You bet. Good to be with you as always.
Really nice to be speaking with you. We've had a lot going on recently. There's turmoil in the global banking sector, as we know, and that has spilled over to negatively affect oil prices. You've been active on Twitter saying that while prices are going down, it's not based on fundamentals. So the first thing I wanted to ask you is if you can explain what we're seeing here, why we are seeing this reaction in oil prices.
You bet. I will do my best to explain it. There are times in the energy sector where you get these dislocations when the physical demand for oil remains strong, and yet the financial demand for oil is weak. And we know that the physical market for oil, biggest commodity in the world, yet the financial market for oil is 30 times bigger. So there are these times, they're brief, but they do happen, where it's the tail wagging the dog. And what I think we saw were it was a very common trade to be long oil as a hedge against inflation and short bonds. And once it was the Silicon Valley Bank and then Credit Suisse, et cetera, you saw an unwind of that. And so you saw people covering the bond shorts and liquidating oil. And we just got the data actually today that last week it was the single largest weekly liquidation in crude contracts going back to about September 2020. And so that reinforces the theme that in 1 week, you had oil fall, I think it was 14%, $10 per barrel. Well, demand didn't crater in that 1 week. It was just the financial demand due to the concerns. And in my mind, that always creates opportunity. You know, crises, panic, fear. For an investor, they should be wanted because those offer you times to build positions at distressed pricing.
Okay, so thank you for explaining that. We're definitely going to come back to what investors can do in this environment. But before we go there, because this move isn't based on fundamentals, of course, we want to cover what fundamentals actually look like. And you always remind us that inventories are key when it comes to oil. We spoke last in December, and I believe that inventories were falling at that time, even as the Strategic Petroleum Reserve in the US was also being drawn down. So I wondered if you could recap what's happening with inventories at the moment.
You bet. So if we look back to last year, inventories fell by about 200 million barrels, despite the biggest release from global SPRs in history. It was 180 million barrels from the US. I think it was 260 million globally. So that was a very, very positive feat. So far this year, inventories have been building as they have every single year. Seasonally, Q1 is the weakest period of demand for oil, and then we progressively get stronger. Now, builds this year have been a little bit more higher than normal. So we have to reflect on, well, why is that? What we've seen is weather this year, both in North America and Europe, have been warmer than normal. So that killed demand by about 350,000 barrels per day. We've also had refineries down more than average. So that's actually aided to builds. Plus, we've had China just starting to reopen. And so when you account for China just emerging from a 3-year lockdown, larger than normal refinery downturns, plus the seasonally warm winter, that accounts, I think, for the larger than normal builds. Looking forward till now, what we're seeing are draws starting from products from crude. That is expected to accelerate throughout the year, even if we remain under a geographical recession. So I would reference an energy aspects piece where they're modeling a recession in the United States, a recession in Europe, demand falling there, yet demand normalization from China plus other non-OECD growth still leading to very pronounced draws. And in fact, I believe the math would show that inventory should end this year at a multi-year low. So that's kind of the path forward from an inventory perspective.
Okay, interesting. Thanks for going through that for us. While we are speaking about the Strategic Petroleum Reserve in the US, I did think it was interesting that they said they aren't really in a rush to start refilling it, even though prices are currently lower. So I wondered if you could touch on that. Does that make sense to you?
It does. And you have to think about who benefits from a rising oil price. OPEC, energy companies, and energy investors. Everyone else gets hurt by that. And so I think it's a bit of a political smokescreen where they were under pronounced pressure from people saying, geez, you've just drawn SPR levels down to the lowest since 1981. It was supposed to offset lost Russian volumes, which never happened. In fact, Russian exports last year were higher from the Ukraine invasion, which we should touch on. And so do I think a US politician is going to take very sacred money, use it to go buy oil to replenish the SPR, forcing the oil price up, which is hugely inflationary, which puts even more pressure on the Federal Reserve to raise interest rates, which increases unemployment, which causes politicians to get fired? I don't see that happening. And so no part of my bullish thesis on oil revolves around the US government replenishing the SPR.
Okay, I think that context is really helpful. So thanks for going into that. And you mentioned we should go into what's going on in Russia. What points would you add there?
Yeah, so people worry, I find, about, well, what happens if the peace breaks out with Russia, Ukraine, which of course we've been hoping for since the beginning. And what we've seen is no loss of Russian production. The Russian minister actually said about a month ago that they would be lowering production by 500,000 barrels per day in the month of March. We are not seeing that in real-time exports using Kepler data. And so this misnomer that, well, my gosh, we're going to lose volumes, and that's, that was a smokescreen for the Biden administration to release barrels out of the SPR. It's actually, you could say that the Ukrainian invasion by Russia has actually been negative on the oil price, not positive.
So talking a little bit more of supply, I always remember you have three baskets that you look at. Those are US shale, OPEC, and the rest of the world. So we've been talking about Russia and what they're seeing in terms of supply. What would you tell us about your other three areas that you look at?
Sure. So we've been a strong believer that we're in a post-US shale hypergrowth world, meaning this period of time when shale growth from three basins of the US grew more than global oil demand. And what we're seeing in the data very, very clearly is a massive slowdown in growth coming out of shale, primarily due to the investors' demand for a focus on maximizing free cash flow, returning that back to investors in the form of variable dividends and buybacks. But more importantly, what we're seeing is geology acting as the gating factor. There was a major conference a few weeks ago called CERAWeek down in Houston. And the talk of the conference were all shale CEOs talking about the maturity of shale, the degradation of inventory quality, the drilling of tier 2 and tier 3 wells versus tier 1, rising gas cuts in oil wells, and most importantly, well productivity getting less. And so plus in-field inflation of about 20%. So meaning historically, you'd have to spend more to achieve the same result. But now if you spend more, that's less buybacks and less dividends, which annoys your shareholder base phenomenally. So it's exciting to me that the flavor of the day from Wall Street, Bay Street can change, but geology doesn't. And so what we're seeing is the likelihood that the Bakken is in plateau, Eagle Ford is in decline, and now the Permian is likely going to be peaking in the next couple of years. And why that's important is that the world's been completely reliant on short cycle production. When we think about long cycle, the projects that take 4 to 6 years to come online from the super majors, investment by those companies remain anemic. It's down 45% since the 2014 lows. And there's a study from Sanford Bernstein that says because of the lack of investment, net growth from all of the global super majors is effectively a big donut from now till 2030. I had the good fortune to spend some time in the Middle East a month and a bit ago. Got to meet with His Royal Highness, the Energy Minister of Saudi Arabia, other ministers, etc. And speaking with these individuals, it reinforced that they too are subjected to cycle time, where Saudi Arabia is adding 1 million barrels per day of new capacity through Saudi Aramco. Well, it's not coming online until 2027. The UAE is adding 1 million. It's not coming online until 2025. And no other member countries have significant ability to grow. So that's really why I'm bullish. It's not only because I think that we will be using oil for the rest of our lifetimes, that demand, I think, will grow for at least the next decade. What excites me is I am challenged to come up with where exactly is that supply going to come from. So I would have said, well, half of it probably US shale. That's massively overly optimistic. Shale is probably in decline in the next 2 years. OPEC is doing their best. They've warned the world to say we cannot shoulder the burden anymore. We need more investment, critical investment by the super majors. But because of ESG and divestments and decarbonization and transitions and all of these buzzwords, these boards can't take the risk to sanction new projects where if you spend money today, you're not getting any production, i.e. revenue, 6 years from now. Let's say it takes you another 2 to 4 years for that project to pay out. Well, that's 8 to 10 years from now. Who knows what demand looks like 8 to 10 years from now, and therefore the oil price. And so there's this structural inability for boards of the super majors to invest. And so it's this chronic mismatch between demand growth and supply growth, which makes me believe that we are in this multi-year bull market for oil.
So these are themes that you've been looking at and talking about for quite some time, but I do think it's good to go over it just to show that it does remain consistent. And when it comes to demand, I want to talk a little bit about the recession question, which we spoke about in our last conversation back in December. You reminded us essentially that demand doesn't do as poorly as people might think during recessionary periods. And I want to check in with you, any updated thoughts on that? And maybe if you do think we are headed to a recessionary time, because it does feel like that's becoming more of a possibility.
Sure, I would defer to my bond team to comment on that. I would say that from casual observation, when I took my family down to the Caribbean for March break, and when our flight got delayed, returning by 2 hours because there were too many aircraft flying over the United States, it suggests to me that economic activity is doing okay. When I wanted to book the same room that I had for March break of 2024, and they said, "I'm sorry, Eric, but we're fully booked." I'm not seeing it in my day-to-day life. What does oil demand do in a recession? So it's natural for us to suffer from recency bias. We remember that which has happened most recently, and that taints our views. That's our filter. So we have COVID, biggest demand shock, oil demand falls 8%. Prior to that great financial crisis, 2008, 2009, oil demand fell by about 2%, just a little less. Prior recessions to that, oil demand didn't fall. What fell was the rate of growth in demand. And so that's kind of where I think we're heading, and that is oil will still grow globally, maybe not in the United States, maybe not in Europe, but certainly in non-OECD. Compounding that is the normalization of China, where every statistic you look at, whether it's road congestion, subway usage, domestic flights, international flights, future hotel bookings, all of the signals is that China is very, very quickly normalizing. And so I think in the next couple of months, once they normalize their own domestic inventory levels and there's a greater call on crude oil all around the world, you're going to see that manifest. And so again, you can believe in a recession in certain geographies of the world. I still think demand could grow by 1.5 million to 2 million barrels per day this year. And again, supply growth is hugely challenged to satisfy that.
Okay, I think that makes a lot of sense. So you've told us previously that in 2023, we could see oil prices go materially over $100 per barrel. I was wondering if that's still in the cards for this year or if it may have been delayed. What are your thoughts there?
Yeah, a luminary always told me when you're making a forecast, either give price or timing, never both. And so I would have thought that we would be at $100 roughly in the second half of this year at some point. And so the thesis is that, we're getting through the Q1 seasonal funk. We've absorbed the biggest release from SPRs in history. China is now very solidly emerging from their lockdown, demand normalizing. Supply growth is being stymied in US shale due to inflation, due to investor concern, all of these things. There's no growth in super majors. And so the pace of inventories drawdowns is going to get better and better and better as the year goes on. What we're dealing with, we're kind of the fog of war, forget the banking crisis or certain crises for certain banks at least, is this chronic fear of, well, my God, we're going into a recession. What does it mean? How can we own commodities in recession? So I think the fundamentals are going to get better and better and better. I don't know how people are going to perceive that if there's this chronic worry about a recession. Others, other than myself, Pierre Anderon, one of the most famous oil traders in modern history, 2 days ago said, well, he thinks $140 by the end of this year. I think we still have a shot at $100 and higher. The thesis, so take my multi-year bull market thesis to the conclusion. If we end this year at multi-year inventory lows, fast forward next year, shale growth gets worse. We're probably looking at 300,000 barrels per day, not 500. Demand grows by another million. You exhaust all of OPEC's spare capacity as they bring on latent shut-in production now. The super majors stagnate. And so it's this chronic situation of inventories continuing on an annual basis to be ground lower and lower and lower. And ultimately you get to a point where the price signal, like literally you're not running out of oil, but inventories are being drawn down to critically low levels. And so if you can't balance things with supply, you have to with demand, meaning you have to kill demand with a high enough oil price. That's not $80, it's not $100. $100, everybody fills up their car and they complain. You know, but you don't change your behavior. You need oil price to go high enough where people can't afford to take their kids down to, you know, the Caribbean, where it's too expensive to fly if you don't own, you know, enough energy stocks. And that's where we're heading, I believe. So that is suggestive of an oil price of $140 to $180 per barrel. When we get there, I'm going to leave that unanswered, but I just think we're in this multi-year period where oil grinds higher and higher and higher in the weeks, months, quarters, and years ahead.
So definitely we're going to have to wait and see, but I will say I do appreciate anyone who comes forward and gives that price and time together, because it takes some courage to actually do that. So, you know, going back to investors, how should investors play this scenario? That's kind of where we started out in the conversation. Previously, you've told us this was a time that we could be buying, and I can only imagine now with prices lower, you're seeing even greater opportunities, but what are your thoughts?
So if you're bullish on oil, if you believe in what we believe, and that is oil is destined to move meaningfully higher, even if you don't believe that, even if you believe in the current price, the most attractive opportunity in my mind is long oil stocks, obviously, but Canada and heavy oil especially. And the reasons for that is that today, given profound energy ignorance, there's still belief that, my God, we're transitioning, we're decarbonizing, this is a sunset industry, we're all driving electric cars in the next couple of years, et cetera. It's perverting people's sense of what the value of long dated reserves is. We have holdings that have 30, 35 years or more of reserves, i.e. of production, i.e. of cash flow, i.e. of dividends. But because the stocks are so mispriced, at $80, so a little higher than we are today, but not by much, we have names trading at 25% free cash flow yields, i.e. with 4 years of free cash flow, they could buy back all of their shares outstanding. And if you have 35 years of reserves, i.e. production, cash flow, free cash flow, dividends, you're only paying for 4 of them, but you're getting 30 years for free. And so I look at this sector where balance sheets are their strongest in history. We project net cash for the entire sector by Q2 of next year, where their leverage targets have been met, where they've pivoted from returning 25% of free cash flow to 50 to 75, soon to be 100%. And so you have an identifiable catalyst, which frankly we helped to create for the sector. You have a catalyst that you can project and triangulate when those companies will start using 100% of their free cash flow. And so if you're trading at a 25% free cash flow yield, at a 33% free cash flow at 100, well, let's say 10% of that's a variable dividend, 20 of it's going to be a buyback. Will a stock stay at a 10% dividend yield while they're buying back 20% of the stock? Or if they're paying a 30% dividend, is that a sustainable dividend yield? So long as the market views it to be sustainable. My thesis is not. And so we think this sector gets re-rated to a 10 to 14% free cash flow yield, i.e. a 10 to 14% free cash flow yield, which is suggestive of significant upside potential for this sector.
Yeah, I saw that you did on Twitter kind of a review of your favorite companies and how do they stack up in today's price environment if you kind of forget what's coming in the future. So I think that's pretty interesting for investors to consider, is what is actually happening right now. I don't know if there's anything else that you would add there.
There is a profound misunderstanding of how much free cash flow is being generated today at today's oil price after we've corrected meaningfully, let alone where we were a month ago, where we were 3 and 6 months ago. And so our work would suggest that at $70 oil, the average company that we model can pay an 11% dividend, buy back 11% of their stock, or do some combination thereof. At 80, 90, and 100, I get giddy thinking about how much returns we believe we're going to get. and the action that that will have in driving the re-rating and valuations, because I'm actively buying stock where we think we're paying less than 2 times an annual cash flow, where they've got 10, 15, 20, 25 years of reserves, where they've committed to give us 75 to 100% of that free cash flow back, either now or in the coming months and quarters. And so what is hugely attractive to me, what any investor should want, is a setup where valuations are so attractive that you get free optionality on a re-rating from where they trade, what they discount, to where you already are. And then you get free optionality in terms of where I think we're going in the months and quarters and years ahead. And so we remain bullish. It's a corny tagline. It's the inverse of my first boss, Eric Sprott, who is a bear, correctly so, for many years, 20 odd years ago. So we remain bullish, not because we're perma bulls, not because we have to be positive and we raise cash tactically at times if we think the sector is overvalued, but because the fundamentals suggest that we should be. The fundamentals suggest oil is mispriced. You've had an exogenous shock that has perverted the price short term. People are allowing price to set narrative. Price has fallen, therefore, my God, demand must be falling. The opposite is true. You cannot let price set narrative. And so we're directed by fundamentals. We do work that we're very proud of in terms of modeling and figuring out where should we be positioned before the herd. It's lent itself to stellar performance. And as good as performance has been, I still think there's meaningful upside ahead in this sector.
Okay, really good points for investors to consider. And as we're wrapping up, I have what I think is a fun question. We'll see if it is. Is there anything that can throw oil off the positive trajectory that you are seeing? So we've gone over, it's not the recession, it's not the banking crisis that's going to do this. Is there anything that you see out there?
It's a very good question to ask. And so what I tell energy investors, prospects, potential clients is there's only 4 things I need to figure out. And it's not meant to demean what I do, but I've got 4 things that I've got to get the column right. Demand, US shale growth, OPEC spare capacity, and what are the global super majors going to do? So let's start with the supply side. US shale. When the luminaries themselves, when the shale CEOs are coming out and cutting their growth forecasts for the key basins, when they're admitting that well productivity is getting worse, when they're saying that in-field inflation is 20%, when their investors are saying, if you cut my dividend or you dare grow and cut your buyback, you're fired. We feel very good that we're in a post-US shale hypergrowth world. We wrote a piece in a national newspaper a year and a bit ago when we said we think OPEC will soon be exhausting their spare capacity. That's no longer a bold call because I had the Secretary General of OPEC personally to my face confirm that call, and now we have the CEO of Saudi Aramco warning the world that OPEC spare capacity is a challenge and when they need the global super majors to grow. And so again, when the most sophisticated oil company in the planet is taking them 7 years to add 1 million barrels per day, you can feel good about OPEC spare capacity exhaustion in the coming quarters. The global super majors, well, it takes them 6 years to bring on a project. Let's just say we went to $1,000 per barrel oil. So every oil company in the planet obviously wants to grow at that point, hopefully. What's the fastest they can deliver meaningful volumes? 6 years. So it comes down to demand. We have to have an economic situation so bad that global demand falls, kind of where we were not necessarily during COVID, but worse than the great financial crisis. So if you think we're going into a global depression, oil is not the place for you. If you think that we can have regional recessions, such as in Europe, in the United States, where China demand normalization, Indian demand all-time high, non-OECD demand growth can overwhelm that, then I think we're in a very good space. So outside of a global depression, I cannot come up with a thesis or something that can supremely challenge my multi-year oil bull market thesis.
Okay, you went through that very thoroughly, so that was great. And I think that's a good place to wrap up on. Thank you so much for going over what's going in the oil market with us. Always really appreciate it.
Thanks for having me as always.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Eric Nuttall with Ninepoint Partners.